If you ask any professional investor what they're looking at right now, they're probably going to say yields. And why wouldn't they? It tends to move in times like these. But what they really should be looking at is small caps. Small caps rallied after GDP growth surprised to the upside in a very big way. This lifted large caps for a little bit, but then the selling continued with small caps outperforming. And this quite frankly tells us everything we need to know, and that's what we're here to talk about. What exactly is that tell? Along with the S&P 500 earnings scorecard, where we stand and where we're going, what strong growth means for inflation, and of course, the US consumer. Can the US growth data be trusted? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and we got a little bit of a dead cat bounce, but not in the tech names. The tech names got sold off. Growth got sold off. Semis were the best performers here in tech. Nvidia down 0.3%, AVGO down 0.26%, AMD Qualcomm took it on the chin. Microsoft and Google were both down about 2%. Continued selling after their moves yesterday. Google down 5%, Microsoft was down about 2% yesterday as well. So we are seeing proper selling here in Microsoft, in Google, Meta as well. And I guess it just has to do with valuation concerns. They just run up a little bit too far. Whereas we're seeing more of the organic market action in the rest of the market that is far more fairly valued. Stuff like industrials were very upbeat. Same here with financials, energy too. And if we dive into the sector analysis, it was very clear to see what the market was doing. Sell technology and rotate into the smaller names in the S&P 500. That is stuff like energy, industrials, materials. So besides the winners and the absolute losers, we then had stuff like utilities, healthcare, real estate down 0.7, 0.4, 0.4% respectively. And it's just very clear what we saw today. We saw cyclical names favored over defensive names and a rotation out of growth names. But that sentiment was only seen in large cap names. Large cap growth was sold in favor of large cap value, like we just discussed. However, in the small factor space, we actually saw growth fairly upbeat, up 1.1%, but still the worst performing factor, while core was up 1.6% and value up 1.8%. We also saw mid caps perform really well. Value, core, and growth each returned 1.5, 1.2, 1.1%. And so it was a clear value rotation here today inside each of the factor segments. But on an absolute basis, large growth got sold, large core got sold, and everything else really saw upbeat price action. So Wall Street's size rotation is clearly still underway, and I do think it's going to continue. And I also think that small caps is a great hedge to have in this seasonally weak period. I think it's going to outperform the S&P 500 by a large margin. But the reason why we saw the price action that we did today actually stemmed from economic data we got. Now, Q2 GDP released, the figure was 2.8%, median forecast 2.1%. I saw figures close to like 1.8, 1.9% as well. But this GDP figure beat estimates on all lines. In fact, the closest estimate to the 2.8 figure was actually the Fed's GDP now. It came in at 2.7%. It's something we looked at all week. What we also saw was initial jobless claims came in at the forecast 235,000, and then durable goods was a bit of a dumpster fire, but the market prefers to take its lead from retail sales, industrial production, and PMIs over durable goods. It's just never been a reliable indicator of anything, and pretty much what this data is telling us is that growth remains robust, the employment market remains cyclically tight, and with tomorrow's PCE report, if we get an inline, potentially cool report like we did with CPI, what we're seeing is robust growth, continued disinflation, a strong labor market that results in a strong consumer, continued consumer spending, and by extension, a strong economy, and that's good for stocks. And despite the stronger than expected data, a September cut is still the baseline. There's an 81% chance the Fed cuts rates in September. So we got stronger than expected growth, rate cuts likely coming in September. That's why we saw the move we did today, with the Russell 2000 up 1.25%, RSP up 0.12%, midcaps up 0.9%, and the S&P 500 actually down 0.51%. Yields continued their uninversion price action. The 2-year yield was flat on the day, but a huge move off the lows, and the 10-year yield was actually down 1% in an environment where you have stronger than expected growth, commodities are obviously going to get hit. Gold was down 1.38%, silver was down 3.74%, and I actually got stopped out of my silver position. Crude, however, did gain, and then the dollar was flat on the day but firm off the lows, and bonds actually acting like a hedge against stocks for once, up 0.82% when the S&P 500 was down 0.51%. Now, there was a couple of reasons why we saw the price action we did in the S&P 500 on a technical basis. So excluding all the macro and the fundamental front, just on a technical basis, today's selling was kind of expected, because if you actually dive into the gamma chart, we could see a couple of glaring things. Number one, the call resistance and gamma flip zone stayed where they are, but the put support zone moved from 5,500 down to 5,400. Look at where we finished the day, at the 53.99 mark, pretty much at 5,400. So the selling we saw was as a result of being in negative gamma, the put support moving down without movements from any other components of the JAX chart. That's often a bearish sign. And also with the amount of elevated negative gamma in the tape, we do continue to see price action that's reminiscent of negative gamma. And in negative gamma, dealers buy with the trend. So they sell into weakness, buy into strength, and that's actually the price action we saw today. In positive gamma, you sort of get this stair step higher, right? Or just the sideways price action. In negative gamma, you get what we see here today. So we opened right here, we gap down, right? Very erratic price action. And then when dealers are buying with the trend, we go all the way up, and then quick reversals, selling into weakness. This is exactly the type of behavior we see in negative gamma. The S&P 500 finished negative on the day. Mega caps getting hit the hardest, down a full percentage point. Absolutely brutal price action, considering yesterday the Nasdaq was down, what, 3.3%? Actually, just dive into the Nasdaq, head on the daily chart, and see how we're holding up on a peak to trough basis. I mean, we probably are getting close to, what, 10% now? Yeah, 9.61%. So the Nasdaq 100 is almost in full correction territory. I think we just have one more red day tomorrow, like 0.1, 0.2, 0.3%, and the Nasdaq 100 is in a full 10% correction, which is completely normal. We actually normally see about 10% correction every single year. So very normal price action in a seasonally weak period, and we're going to see where this bottoms out. Ultimately, if we do dive on the weekly chart, you know, the real key level we'll be looking at is just a 17,000 flat level. It's a psychological level, and there is plenty of room to run to the downside, but the first obvious level is where we made these wicks in the weekly chart right here. So mega caps looking a bit sick. The S&P 500 holding up a little bit better. The IWM looks very, very strong. This is a weekly chart of the IWM. If we just hop onto the daily chart, looking significantly strong, actually holding up here in this range, which is very, very constructive for higher prices. That's really, really good. I think we're going to see further consolidation in this range, and then eventually we'll probably just break out, move higher to new all-time highs. If we actually just zoom out, take a measured move from where we are right now back to new all-time highs, it's just a 10.76% move. Absolutely kind of crazy. Nobody wanted Russell right here. Everybody's trying to claw in at small caps, trying to get the best possible price at the moment. So very interesting trade. But the S&P 500, where does that leave us for the rest of the week? We play the game very, very simply. The truth is, in negative gamma, we sell weakness, buy strength to the put support. We currently are at the put support at 5,400. Now it's just a waiting game to see what happens. Do we move down again to the 5,300 area? If that's the case, our target is the 5,300 area. But if we stay here at this 5,400 area, yeah, we could get some volatility to the downside, but we probably will consolidate. So I would say that right now, we probably consolidate sideways in the S&P 500, unless the put support moves down, then we go down to 5,300. That's the price action I'm seeing. I want to move to 5,300. Hell, I want to move to 5,000 so I can load up that I've had. And if you guys are in large caps and you do want to hedge, look at something like the S&P 600. I think it's going to do really, really well. In my portfolio right now, PAYC has really steadied a lot of the losses I've had in my portfolio. I mean, I loaded up a lot of Paycom right here at these levels, and the stock's up 15% since then, when my portfolio, which is a lot of Meta, a lot of Visa, PayPal as well, is probably down about 4% in that same time period. Just those three stocks. Paycom has actually pared a lot of the losses. Without Paycom, that portfolio would be down about 9%. So Paycom really holding up this entire portfolio at the moment. in my ETF portfolio. The ticker QSML is acting sort of as the same hedge. My ETF portfolio is a lot of US large cap names, and this ticker right here has been very, very strong in the face of the mega caps coming under pressure, and it's acted as a very good hedge, and we'll see if that continues to play out. But to be honest, when it comes to the Nasdaq 100, this is probably closer to bottoming out than it is to topping out. The S&P 500, guys, very similar situation. We just have to watch that put support if it moves down or if it stays here at 5,400. If it does stay, I think we probably bounce and move up right here. The bulls did try that today. I mean, this is a pretty ugly candle, but to get a wick like this, you do have to have bullish support. And we did see a little bit of a run early on, but the bears, yeah, were very, very strong. And the fact that we couldn't actually break yesterday's high, that is a little bit concerning, but we did stop right on the 5,400 area. So we have to see where we go next. And there's literally only two options. We either bounce from here, move higher, or we break below this and take a trip to 5,300. And this really is our first level of technically strong support that the bears will really need to hold. We're at a critical point in the S&P 500 with PCE tomorrow. Let's hope for the best, but as bulls, buy the dip, don't trip. Now let's talk about sentiment. This is the AA sentiment survey, and members are asked, what direction do you believe the stock market will be in the next 6 months? Just to give you context, bullish sentiment votes, the average since like 1990 is about 33%. So to see this number with the recent price action we've seen in the S&P 500 is still relatively bullish, but what we've seen is a pullback here in the bulls, an uptick in the bears. Those that are neutral kind of remained flat, a minor uptick, and we definitely are seeing bullish sentiment pull back, the bears getting a bit excited. This is about the historical bearish average, and in last week's video I actually said the second the AA sentiment survey gets over 50%, we normally actually do see near-term volatility, but oftentimes hitting the 50% mark has led to outsized S&P 500 returns 6 months, 12 months later. So near-term volatility, long-term it's really good, because you need bulls in a bull market, and this coupled with this tells us the market is bullish. And once this gets to like the 35 region, around there, maybe closer to the 30, between 30 and 35, that's when we can really start looking at buying the dip, because sentiment will be in the dumps and you always want to buy the fear. So looking at earnings, we're not going to dive into a specific name, but I did have a look at American Airlines. They were pretty much flat on the day. Skechers were up 2% there in after hours. We did have a couple of other names. AbbVie was up 3% on the day. Very good earnings. The market liked what they did. Same here with RTX. Raytheon up 8.24%. It must be very bullish to see that type of price action on the day. Texas Roadhouse up 3.34% on the day, but after the earnings dropped 4.2%. Here in the after hours, pretty big move. Clearly the market likes what they're seeing, and the same here with Deckers Outdoors up 10%. Absolutely crazy price actions. Look at this volatile after hours market, but red on the day, down 0.5%, but 10% after hours on their earnings, and we'll see how that translates in tomorrow's price action. This here is the earnings scorecard for the S&P 500. It's blended earnings growth here for the second quarter. Now this is my personal proprietary data, and for those of you that are members of this channel, if you want access to this scorecard, which I update every single day at around about 8 a.m. Go to the Alpha Chasers spreadsheet. You can grab it right here and you get the update. 8 a.m. Australian time is about 7, maybe 7:30 p.m. New York time. And this is where we stand right now. 11.6% on the earnings side. A huge beat compared to what the expectation was at the start of earnings season. However, 133 companies have only reported. I think we'll get more certainty once we have the majority of companies report in the next couple of weeks. On the revenue side, things are looking rather flat. 4.6% was the expectation. That's what we're reporting right now. And then X Energy, we're looking at 4.5 and 12.6 on the revenue and earnings side respectively, with margins largely unchanged. The best performing sector is comm services on the earnings side, followed by healthcare, financials, and technology. Things looking a lot more lackluster here on the revenue side, with not one single sector reporting double-digit revenue growth, and the revenue beat rate is actually near 2016 lows. So a lot of companies not beating on revenue, but a lot beating on earnings. Again, that just goes to show the operating leverage a lot of companies are developing, and that's actually what we see in periods of slightly higher interest rates. cash becomes more expensive, then companies focus on decreasing expenses and they don't grow as much because they don't want to take on as much debt. And you'll find a lot of companies building a lot of operating leverage in periods of high interest rates. The second we get rate cuts, we see more companies taking on more debt to grow, and we should see revenue surprise to the upside, and then earnings should remain relatively robust. We actually did see this here in sort of 2019. You could see this is where the earnings beat rate was. This is where the revenue beat rate was. Then when we got the rate cuts that we did in 2020, we saw revenue move up in a very big way. So too with earnings. And after we got rate hikes, we saw that come down as well. And if we actually dive into the specifics of the revenue surprises, we can see that even though the low beat rate, we are actually still beating ever so slightly to the upside by 0.9%. Most sectors are beating to the upside, materials being the best and energy actually being the worst, seeing a revenue miss of 3.3% on average. Yesterday in the S&P 500, we had a 2% down day. The S&P 500 was down about 2.35%. And I have some very interesting data with regards to 2% drops in the S&P 500. On average, we see 5.9 2% drops per year. And this is our first one in 2024. And it's been a rather tame year. In really volatile years, we could see 20, close to 30, even upward of 40. But this right here was 2008, and we've only had one in 2024, well below the average. So if we do actually see more 2% down days, completely normal. It happens. Most years have a few bad days, and we actually went on quite the run, 356 days without a 2% drop. Last time we saw this was 2018, and then a year in 2008, right before the GFC. And there's only been about 5 or 6 other years that have actually beaten the year we saw in the last 12 months. So this lack of volatility is actually an historical anomaly, and it's actually a reason to remain bullish in the long term. This right here is the S&P 500 longest streaks without a 2% drop. These are the trading days, and then this is the forward returns after that streak ends. 1 month, 3 months, 6 months, 12 months later. And normally it's actually a very bullish thing. You could see just 1 month later, we have returns 1.5% on average, 1.7% median, 78.6% hit rate. And it gets kind of crazy 12 months later, 10.6% average, 10.5% median, 71.4% is the hit rate. This compares to S&P 500 seasonality in total, all years 1950 to 2023, where we actually see average returns of 9%. So buy the dip, don't trip. And we also are in a seasonally weak period of the year. Now, this is S&P 500 monthly seasonality from 1928 to present. Now, in August, we actually do have a positive month, on average up 0.58%, but the hit rate is rather poor. Only negative month we do see after August is September. We do then want to buy the dip because October, November, December tend to be very, very positive, up 0.56, 0.76, 1.3%. And the hit rates tend to be very, very good, well above 50% and even 70% here for December. So this market volatility we're getting, guys, what you want to do over the next 2 to 3 months is build your cash, find names that you like, find ETFs that you like, dollar cost average every single week. It's always good to get into that habit of dollar cost averaging into the names and ETFs you like. And then if we do pull back maybe to the 5,200, 5,000 level in the S&P 500, that's when you would start to load up, because stocks and ETFs get very attractive when the S&P 500 will be around that level. So let's talk GDP. Second quarter GDP figures came in for 2024, 2.8% in real GDP. Kind of crazy. The market expectation, the consensus expectation was about 1.9%. A couple of the other banks had it closer to 2.3, 2.4, 2.5%. I've been saying since last week, after the strong industrial production numbers, that we were probably going to see 2.3% at minimum, or we got 2.8%, beat everybody's expectations. Private domestic final purchases came in at 2.6%. And you know what's kind of crazy? The second quarter GDP was kind of meant to be a trough quarter. quarter. I mean, at the start of this quarter, Goldman actually had a 1.8% consensus estimate here for the second quarter. Now, they did revise it up in the last couple of weeks to about 2.1, 2.2%, but this is now sitting at the 2.8% level right here. This is what actual second quarter growth looks like if we were to like draw a graph. The next two quarters for 2024 is 3% and 2.5%. This is going to support growth, the economy, the consumer, stocks. This is very, very good. And if CPI and PCE continue on the path they are right now, in other words, disinflation, growth plus disinflation coupled with rate cuts is normally very, very good. And in light of this, the consumer is also doing very good. This is Goldman Sachs consumer dashboard. They pretty much rank spending, employment, income, wealth, debt, and confidence, and then calculate an average. And that average right now is sitting at the 57th percentile, signaling that the consumer remains reasonably healthy. And actually look at confidence right at the 31st percentile. In other words, this is weighing on all of these measures, and probably it means that the consumer is far more healthier than this measure right here, which is just a survey. I think they should just remove confidence in total. Like, it's just a survey. It's just what people feel like, whereas spending, employment, income, wealth, debt are all tangible measures that you can draw data-driven conclusions from. But let's actually look at household wealth. This right here is very, very interesting. It's American household net worth, assets, liabilities, and then total net worth. And then they have disposable income and personal income, and household balance sheets strengthened due to an increase in asset prices. The net worth to disposable personal income ratio is also at all-time highs, telling us the consumer is strong and they have a lot of assets to draw on. This is what makes a strong consumer, and part of the reason why the economy has been so resilient in the US. At the same time, the labor market remains robust. And yes, what we are seeing with the jobs workers gap is a pullback. However, to me, this is the labor market fully rebalanced and job growth remains relatively healthy. And the forecast is for continued normalization of the labor market for the rest of 2024. And continued firm labor demand and immigration are expected to average job growth at 168,000 per month for the rest of 2024. The unemployment rate steady at 4.1% by the end of the year. And if we have a labor market that's fully balanced, robust growth, continued disinflation, and the Fed cutting rates, equities do really well in that type of environment because earnings grow, margins expand, and all you want to do in these dips, guys, is buy, buy, buy. So today, guys, we had data. We spoke about it in the video. Tomorrow, we have PCE, personal consumption, personal income outlays, and the expectation there is 0.4%. Then headline month over month, year over year is 0.1, 2.5%. Then core PCE month over month, year over year is 0.2, 2.6%. The personal savings rate at 3.8, personal spending 0.4, and then Michigan sentiment at 66. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.